Bitcoin, a name that echoes throughout the halls of finance and technology, has disrupted the world stage like no other. Its potential to revolutionize traditional financial systems and its enigmatic origins continue to captivate and intrigue. Born from the shadows with its creator, the elusive Satoshi Nakamoto, shrouded in mystery, Bitcoin has become a symbol of change and innovation. Yet behind the enigma of Bitcoin lies a myriad of theories, each as intriguing as the next. The birth of Bitcoin is no mere coincidence, but rather a testament to the enduring influence of the cypherpunk movement. This movement, born in the late 20th century, championed the principles of privacy, encryption, and decentralization. Cypherpunks envisioned a world where individuals empowered by technology could reclaim their privacy and autonomy from centralized institutions. Enter Bitcoin, the brainchild of the enigmatic Satoshi Nakamoto. Introduced in 2008, Bitcoin's design embodies the cypherpunk ethos. Its foundation, a decentralized ledger known as the blockchain, ensures transparency and prevents a single entity from controlling the network. Meanwhile, its use of cryptographic techniques safeguards user anonymity and transaction security, echoing the cypherpunks' call for privacy through encryption. In essence, Bitcoin is an epitome of the cypherpunk's dream, a tool that leverages technology to facilitate peer-to-peer transactions free from the shackles of central control. Indeed, Bitcoin is the cypherpunk's dream come to life. Gold, the timeless store of value, may have met its digital match in Bitcoin. This intriguing idea is rooted in the theory that Bitcoin, much like gold, has the potential to serve as a store of value immune to inflation and government control. The key lies in Bitcoin's limited supply, with only 21 million Bitcoins ever to be mined, a feature that echoes gold's prized scarcity. This limited supply, coupled with a growing global adoption, forms the backbone of the digital gold narrative. Bitcoin's deflationary nature, a stark contrast to traditional fiat currencies susceptible to inflation, amplifies its allure as a potential economic safe haven. In a world fraught with economic uncertainty, the idea of a digital asset that could serve as a hedge against volatility holds undeniable appeal. As we bear witness to the unfolding narrative of this digital phenomenon, we're left pondering, could Bitcoin truly become the digital equivalent of gold? Only time will tell. Bitcoin's resilience is not a product of chance, but rather a triumph of game theory and cleverly designed incentives. This resilience stems from Bitcoin's consensus mechanism, known as proof of work, or POW for short. This mechanism leverages principles of game theory, a branch of mathematics that studies strategic interactions, where the outcome for any participant depends on the actions of all. Here's how it works. Miners, the participants in this game, compete to solve a complex mathematical puzzle. The first one to solve it gets to validate transactions and add a new block to the blockchain, earning rewards in the form of newly minted bitcoins and transaction fees. This competition incentivizes miners to participate honestly, as the rewards are contingent upon their cooperative behavior. In addition to game theory, Bitcoin's resilience is also fortified by its decentralized nature. Bitcoin isn't controlled by a single entity or central authority. Instead, its control is distributed among a global network of nodes, each holding a copy of the entire blockchain. This decentralization means there's no single point of failure, making Bitcoin resistant to censorship and manipulation. Think of it this way. If one node goes down, there are thousands of others to take its place. This makes attacking the network incredibly difficult and expensive, as a malicious actor would need to control more than half of the network's computational power to have a chance of success. Thus, Bitcoin stands strong, a beacon of decentralization in an increasingly centralized world. Yet not all theories paint Bitcoin in a positive light. Some see it as nothing more than a speculative bubble, waiting to burst. Critics often draw parallels between Bitcoin and historical instances of market crashes, such as the Dutch tulip mania of the 17th century, or the dot-com bubble at the turn of the millennium. This theory, known as the speculative bubble theory, suggests that the value of Bitcoin isn't tied to its intrinsic utility, but rather it's primarily driven by speculation. The idea is that investors are not buying into Bitcoin because of its potential as a future currency or a store of value. Instead, they're buying in anticipation that they can sell it at a higher price in the future. These critics warn of a potential market crash, a sharp correction following a period of irrational exuberance. But the question remains, is Bitcoin truly a bubble? Or is it a misunderstood innovation that's just beginning to unfold its potential? Whether Bitcoin is a revolutionary financial instrument or a fleeting speculative bubble remains a matter of perspective.